welcome to the Swedish House of Finance. We have recently moved back here to the mothership. We were at Drottninggatan earlier, and we are very happy to be back at the Stockholm School of Economics, the main building. My name is Pehr Wissén. I work at the Swedish House of Finance, and I will moderate this event this afternoon. And we will talk about, as you have seen, how to develop equity capital markets in Europe and in the US. We will discuss equity market, how they function, how they develop, what roles different regulations and rules have, and are they sort of heading in the right direction, and we will do this against the background of research performed by Alexander Ljungqvist, whom you've seen up on the screen. He will make the first presentation there, Alexander is. And against the experience from the US, we have Eun Ah Choi here visiting us from Washington. Not us the whole week, but Stockholm for a whole week. And against the rules and regulations of the EU, and we have Johan Almenberg from the Ministry of Finance. And last but not least, we have Björn here from Carnegie Investment Bank telling us what's really happening on the market in these respects. So, and I will present this for panelists a bit more carefully when they come up on stage. And we will do it like this. They have 10 minutes each. We will start with Alexander, and then with Jonas, and then with Johan, and then with Björn. And after that, we will have roughly 30 minutes for discussions within the panel and between the panel and yourselves. And take the opportunity to, you don't have to ask questions, you can voice opinions or whatever, throw yourself into the debate. So that's so that we all engage in this event. Yeah, I suppose, yes, that's about it. So, welcome on screen, Alexander Ljungqvist. I'm looking at you from where I stand. Alexander is the inaugural holder of the Stefan Persson Family Chair in Entrepreneurial Finance at the Stockholm School of Economics. Before joining the school, he has taught at New York University, Harvard Business School, London Business School, Oxford University, and Cambridge University. He has a long international experience. He has a long list of published papers in prestigious journals. He's been elected Best Teacher of the Year, and he has a deep knowledge in this field. So with these words, Alexander, please, the screen is yours for the next 10 minutes.
Thank you. I hope you can hear me. I come to you from my home because I had knee surgery a week ago, and I can't move. I'm literally locked up at home. And I'm also on painkillers. So if I don't make any sense whatsoever, then let's blame pharma. Right. I want to share with you some statistics and some thoughts about the shrinking of the stock market. And as we do that, we should think about why we have stock markets in the economy in the first place. Stock markets have multiple customers. Amongst them, they have companies and investors as their customers. And companies benefit from the existence of the stock market because the stock market provides them with a platform through which to raise equity capital. And stock markets facilitate that by setting and policing listing standards that look after the public interest. At the same time, stock markets are also venues on which shares are traded, as we all know. And trading of stocks provides a number of benefits to various parties. It provides liquidity to the holders of the firm's securities, which allows them to sell if they want to get out, buy if they want to get in, and allows them to build diversified portfolios and achieve their own risk-return preferences that way. Trading also helps to reallocate ownership in the economy, and that hopefully helps in the governance of capital. And then finally, trading puts a price on a firm's shares, so price discovery. And by putting a price on a company's shares, the market provides feedback to management about whether, let's say, a given investment is a good idea or not. And that helps in allocating capital. So I don't think I'm going to be contradicted by anybody in this room when I say that stock markets fulfill very important economic functions. But at the same time, there's a concern about the health of the listings market. And this is this notion of the shrinking stock market. And as we go back a few years, not really that far, let's say to 2018, Nasdaq raised the alarm bell in the US, talking about a shrinking stock market, not in the sense of value, obviously, but in the sense of the number of firms that are listed. And we see the same debate on this side of the Atlantic. In the middle here, you see a headline from the FT from 2019, where the FT talks about a global drop in IPOs that stirred fears for shrinking public markets. Then we had the pandemic, and listings were very healthy for a couple of years. But today we're sort of back in a world where we don't see many IPOs, and the FT is running a series on the lack of health in the European stock market in particular. So there's a debate out there in the media and amongst regulators about the health of the listings market. And if we zoom out for a moment from our very current experience and put the health of the listings market in the broader perspective, then the trends look as follows. Here you're seeing the number of listed firms in the US going back to 1841 and ending in 2022, December of 22. And as you can see, there's been a dramatic rise in the popularity of a stock market listing over a couple of centuries or so. But the number of listed firms peaked in 1997 at, call it, 7,500, and has since dropped by more than 40%. And it's been basically a one-way ride, almost with the exception of the pandemic, where the stock market has been shrinking, except in 21 and 22. So that's the US. Europe doesn't look much better, possibly even looks worse. Here's the number of listed firms in Europe for 7 leading exchanges, the Euronext exchanges plus London and Frankfurt. And there you see a similar pattern. The number of listed firms peaked more than 25 years ago in 1996 at about 5,500 and has since fallen by 55%. We're roughly at 2,500 today. The listings are falling out of favor. Now, curiously, there's one big exception, or small exception, to this general trend, and that's Sweden. Because in Sweden, we've had quite a healthy listings market, and the trend, if anything, has been up rather than down. So there's a curious exception here, but perhaps we'll talk about maybe not. All right, now there's research on the shrinking of the stock market, and much of it focuses on the trade-off between the costs of being public and the benefits of being public, or put it differently, the costs of being private and the benefits of being private. And there are commentators and academics who say that the costs of being public have increased as more and more regulations have been put on public firms, and perhaps as more and more shareholder activism has put strain on public firm managers. At the same time, the cost of staying private, never going public in the first place, have been reduced as the private markets, venture capital, private equity, and so on, have developed and have boomed over the last 20 years. So it's that much easier to stay private. And a prominent example of such a firm that stays private because the private markets are so much more liquid these days would be Northvolt, a Swedish battery maker. And Northvolt stands out because it has managed to raise $7 billion since its founding in 2016 in the private markets. The private markets cannot provide the kind of capital when in the past they couldn't. But I think in addition to these cost-benefit kind of reasons, there is also almost a perfect storm here as several megatrends have collided. This is less well-researched, but I think it is worth thinking about these issues. So there are various megatrends here that I think have affected the listings market. One is the boom in algorithmic trading and high-frequency trading, which I think, and our friends from Nasdaq might contradict me on this, have diverted the attention by many of the exchanges towards the trading side of things and away from the listings or capital formation side of things. So the demand has been perhaps that much more urgent from high-frequency traders to put ever more fast connections in and so on to enable that kind of trading rather than focusing on the listings market. The equity markets have fragmented through regulatory initiatives, and this is particularly the case in the US. And fragmentation has led, amongst many other things, to competition for liquidity that exchanges have responded to in a number of ways, which perhaps really don't aid in the health of the listings market, but aid in other ways. Then on the investor side, we see ever more indexing, and that's one of those mega trends. Indexing, I believe, comes in part at the expense of smaller cap firms, which get less interest from investors and less research coverage by brokerage firms, as it's just that much harder to be visible. The fourth megatrend is that private equity has boomed, enabling ever more companies to leave the stock exchange, and for companies that might have joined the stock exchange to be acquired in the private markets instead. And then finally, in the economy, I think it's unarguable that intellectual property has become ever more important for the production of wealth. And intellectual property, if you have to disclose it, runs the risk of being appropriated by others. And by staying private, maybe you can reduce that risk. So there's a lot on the why. I want to focus in my remaining time on the so what. Why should we care that the stock market is shrinking? If you think about the stock exchanges, Nasdaq and its competitors, then stock exchanges may have prioritized trading over listings. And when they did that, they made privately optimal decisions reflecting demand from their customers, competition, regulation, and so on. Think about companies, and companies that choose to delist or not to go public in the first place, make optimal decisions reflecting the costs and the benefits of being a listed company. Investors likewise are making privately optimal decisions. Institutional investors who choose to focus their attention on liquid large cap stocks, well, they do that for a reason. And retail investors who choose to invest in a passive index fund instead of stock picking perhaps small cap firms, again, do that for privately optimal decisions. And the common denominator here is that everybody is just privately doing the right thing. But to an economist, the question then becomes whether privately optimal decisions in this instance lead to socially optimal outcomes for the wider economy. And when that is not the case, economists talk about, and I apologize for the technical language here, externalities. So externalities in economics are a cost or benefit that affects somebody else that you do not take into account, and that somebody else doesn't have a say in your actions. So you impose a cost, or you perhaps impose a benefit on somebody else who's not party to your choice of what you're doing. Let me give you a couple of examples of what this is. There are negative and positive externalities. So it's like going back to school, but you are at school, so enjoy. So negative externalities arise when third parties suffer a cost that the decision maker doesn't take into account. So for example, air pollution that is produced by a factory might increase medical costs in the surrounding area, and the polluter probably doesn't take that into account and therefore over-pollutes, produces too much pollution because they don't incur the cost. Another example is this. Venture capitalists invest in startup. That's a good thing, and they do that because they're hoping to make money. The kinds of startups they might invest in include these guys here, and these guys here provide personal transport services. And one of the externality consequences of funding these kinds of companies, of which there are a great many in Stockholm and elsewhere, might be this. We all get fatter because we don't use our legs as much as we used to. And that would be an externality on the healthcare system. So there could be negative externalities that are not taken into account. There could be positive externalities. That is a benefit that your action imparts on somebody else, but you don't benefit yourself from that benefit that a third party gets. So you can't monetize it, and therefore you don't take it into account in your decision. What that will lead to is that you under-provide this benefit to others. An example would be that immunizing your children reduces the risk of infection for everyone. It contributes to herd immunity, but you're privately incurring the cost that perhaps there's an adverse reaction in your children when they're immunized. So you could free ride on everybody else's immunization, but thereby you're reducing the benefit to everybody by not contributing to herd immunity. So lots of externalities everywhere you turn, they are ubiquitous. Now, back to listings. By not listing, companies can impose negative externalities on others. One of those externalities is reduced price discovery. If you don't list your stock isn't traded. Therefore, nobody is producing information about you, and you're not disclosing much about yourself either. To the extent that any information about you is of benefit to investors when they price stock market listed firms' shares, perhaps because you're a big competitor or supplier or customer of a stock market listed firm. By not listing, you're depriving investors of the benefit of that information. This has been shown, I've worked on this for a while, and it's quantitatively quite important. By not going public, you're also reducing competition. If you let yourself be acquired by an incumbent firm instead of going public and competing with the incumbent, you're depriving consumers of the benefit of competition and innovation. And then another one that I like a lot, and I'm thinking about a lot at the moment, but there's no research on this yet, is that by not going public, you're depriving investors, certain types of investors, of access to investment opportunities. So what I have in mind here is that companies that can only be invested in through private markets are only investable by those investors who have access to private markets. And those tend to be, by rules and regulations, the rich. So in the US, it would be accredited investors, for example. So by staying private, startups would deprive the man in the street, the many, the poor, if you like, of access to investment opportunities. And that could contribute to the increasing wealth inequality that we've seen over the last 2 or 3 decades. So what are the takeaways? Takeaways are, first of all, a fact. The stock market has been shrinking. This is true in many countries. Sweden happens to be an exception. And I think there's some concerns that come with this, but they're nuanced. The concern would be if those privately optimal decisions that lead to the shrinking of the stock market by investors and companies and stock markets themselves lead to adverse economic consequences for somebody else, consumers, investors, general welfare. Only if the answer to that question is yes, if there are indeed externalities, should we consider policy interventions. This is standard economic stuff. We would always say this in every application. Only if we have a market failure do we need a policy intervention. But I think this is worth emphasizing because we are seeing policy interventions by regulators in the US, by the EU Commission, that are perhaps not grounded in this way of thinking. What kind of market failure are they addressing? What kind of externalities are they trying to fix? And as we are thinking about policy intervention, getting the policy intervention right is critical because typically these policy interventions entail a reduction in investor protection, at least on the margin. And therefore we have to ask the question, how much investor protection we should sacrifice to make listings more attractive. So I'll stop there and hand over the microphone to Pehr.
Thank you very much, Alexander. That was a great introduction. So on stage, Eun Ah Choi. She serves, I need to read this to get it right, Senior Vice President, Regulatory Operation, and heads the US listing qualifications, market watch and options surveillance teams at Nasdaq, Washington. In her role, Eun Ah is responsible for assessing the qualification of listed companies and continued compliance review with Nasdaq's comprehensive listing standards. She also manages Nasdaq's surveillance program over equities and options markets to maintain an orderly marketplace and level playing field for investors, market participants, and listed companies. And right now, Eun Ah is going to be our guide to the US equity markets.
Sounds
Please.
great. Thank you very much. And thank you, Alexander, for that wonderful backdrop and information. And thank you, everybody, for being here today. I'm really privileged to be talking to you about our U.S. listing markets and capital markets generally. So within the U.S., just to set the framework, the Securities and Exchange Commission has the jurisdiction over reviewing the disclosures made by public companies. And that comes under the 1933 Act, 1934 Act. And that goes into the review of the prospectuses that companies provide in the offer and sale of securities. Oh, including the, is this better? Offer and sale of securities, including IPOs. And then they also review the periodic reports that companies provide under the 34 Act. We at Nasdaq are also regulators, and we derive our regulatory authority from the 1934 Act, the Securities Exchange Act. And we also review and separately qualify companies to be listed on our exchange.
And we have financial conditions requirements, liquidity requirements, as well as corporate governance requirements. So both regulatory authorities have three-pronged goals: capital formation, investor protection, and efficient and orderly markets. And we take all of those goals very, very seriously. So with respect to our listing standards at Nasdaq, as many of you know, those standards haven't really changed all that much in recent years. And I don't expect that to change drastically anytime in the near future. With respect to the SEC, however, especially under the current leadership of Gary Gensler, they have been incredibly prolific with respect to their disclosure-related rule proposals. That includes disclosure related to climate change, disclosure related to cybersecurity, disclosure related to SPACs that really enhances the requirements that the SPACs have to follow, as well as other matters related to ESG for funds. And there's also a talk and speculation about disclosure that haven't even been proposed yet that will have meaningful impact on public companies, including human capital policies and procedures with respect to public companies, as well as additional disclosure for private offerings by private companies that's being speculated about very much in recent months. So that kind of backdrop and activity is coming in at a very interesting time. You know, the market has turned within the past 2 years from 2021 being one of the biggest IPO boom markets that we've seen since early 2000s. In 2021, for example, and into 2022, we had over 4,000 listings on Nasdaq alone, and that represents $19.3 trillion of market cap for Nasdaq-listed securities. So that's a tremendous amount, and numbers that we haven't seen in the past. Now, when you look at that boom, it really encompassed small cap IPOs, large mega cap IPOs, SPACs, as well as foreign issuers in the US, Chinese companies in particular. When you look at 2022 into 2023, it's the inverse of what we've seen in 2021. So now what we see is a significant reduction in IPOs. We do have them at Nasdaq, and they tend to be for small cap IPOs, $25 million of offerings, very small, $100 million of market cap or less sometimes. Some SPAC IPOs are continuing to happen, believe it or not, in this environment. And a big significant portion of those IPOs tend to be from China. Despite the fact that there is an ongoing sort of tension between the SEC, PCAOB, and the Chinese securities regulators with respect to the US being able to inspect the books of auditors in China. So it's an interesting backdrop. And what we have also seen with respect to continued listing public companies is that there is an increasing number of deficiencies with respect to being able to comply with the listing standards. So we are certainly seeing a number of deficiencies with respect to our requirement to have a minimum bid price of $1. And that tends to be about 70% of the deficiencies that we're seeing right now. We're also seeing that impact more of the biotech and life sciences industries in the US. And part of it is that that industry has just a different revenue model in which they need the investment, they need to invest the money to go through the clinical trials in order to develop a drug and then ultimately be in a position to be able to generate revenue. So this kind of market downturn is really difficult for those companies because they're not able to tap into the capital markets to be able to raise funds in an efficient and easy way. Another deficiencies that we're seeing is with respect to SPACs. SPACs are looking at these SPAC opportunities to engage in mergers, and they're having a very difficult time finding quality targets. As a result, many of the SPACs are voluntarily liquidating, and I think that's a good way for them to exit the market. However, there are SPACs who are trying to survive either through extending their life cycle beyond what they had marketed, which has usually been 12 to 18 months. And when they go through that extension, they have to go through a shareholder vote. And the shareholders are now redeeming their shares to the point where that SPAC doesn't have enough liquidity to stay public. And that's the new phenomenon that we've been seeing since the end of 2022 into beginning of 2023. And then these SPAC combinations also are challenging because even after they are able to find the target, there are so many redemptions that they are not able to qualify sometimes in order to stay listed publicly. So very interesting sort of dynamics that we have. With respect to sort of how we, at Nasdaq think about our role, we are not just focused on regulatory compliance, but we are committed to being a thought leader in terms of the regulatory policy making process within the United States and beyond. And so our CEO, Adina, has spoken a lot about this in terms of revitalize, thinking about long-termism, thinking about making things easier for SMEs, the small, medium-sized enterprises, to be able to tap into the market, level the playing field, simplify the disclosure process, have a tailored approach to regulation, not a one-size-fits-all, to accommodate smaller companies being able to tap into the capital markets. Because going back to the three-pronged goals that we have, a vibrant capital market and a vibrant IPO market is essential to creating wealth for all, as well as investor protection and maintaining orderly and efficient markets. So I'm going to dispute a little bit of what Alexander said in the past about trading versus listings. I can tell you that I have the unique position of working very closely with our listings and trading teams, and we're equally focused on creating the vibrancy for listings and efficiencies and orderliness with respect to our trading markets. So with that, I'll turn it back over to you.
Now I'm online. Thank you very much. I think we could come back to SPACs and some other things in the following discussion. Now we have Johan Almenberg, our third speaker. He is State Secretary at the Ministry of Finance. He has previously been head of the Economic Policy Analysis Division in the Monetary Policy Department at the Swedish Riksbank, has worked with the Swedish FSA, Konjunkturinstitutet, and he holds a PhD in economics from the Stockholm School of Economics. So welcome back to your alma mater.
Thank
Please.
you, Pehr. You forgot to mention also over the years a frequent visitor to these events that you've organized. They tend to be very good. Thank you very much for letting me come and speak today, and thank you to the previous speakers as well. I think you raised many important points. I'll try not to repeat too much, but to add some more content here by focusing on the Listing Act, so the proposal that came at the end of last year. I'll say something broadly about the contents of the proposal, or the proposals, because it's really a set of proposals. Then I'll say something about where we are in the negotiations at the European level, at the European Union level. And finally, I'll say a few more words about a couple of aspects of the Listing Act that I think are particularly interesting to consider in a Swedish context. So starting first with the broad picture. So a few years ago, the European Commission presented an action plan for the Capital Markets Union. And I think it's fair to say that the Commission has certainly delivered on this. There's by now a fairly large number of proposals or legal files, that they're also called, that have been put forward by the Commission, and many of these are currently being negotiated during the Swedish presidency. They have arrived at different times, so some of them are at more advanced stages of negotiations. The Listing Act came in December last year, so that's still at a relatively early stage in negotiations. I'll tell you more about that in a moment. But I think the core of this proposal is to try to advance capital markets in the European Union in really two different dimensions. One is to make these markets work better to increase access for firms to raise capital in this way, in particular for small, medium-sized enterprises, SMEs. So that's one dimension, and that's really about trying to reduce the regulatory burden, which, as the previous speakers have mentioned, it might involve a trade-off also with investor protection. But that's really just sort of improving the access to these capital markets throughout Europe. And then I think the other dimension has more to do with a pan-European perspective, which is to try to make sure that national boundaries play a slightly smaller role in defining what the relevant capital market is for a firm that wishes to raise capital in this way. So another very short way of saying that is harmonization. And that, of course, is very much in line with the idea of the Capital Markets Union, which you could think of as a special case of really trying to develop and improve and foster the common market in Europe. The term itself, I think, is from 2015, Juncker, but the discussions about what we these days refer to as the Capital Markets Union have been going on for much longer than that, and for about as long as the discussions about the common market. So I think that's really sort of the big picture, what it's about. Why is it important to improve capital markets in Europe? Well, it really links to the idea of raising competitiveness, making sure that there's good access to capital for firms. We have a tradition of very bank-centered finance in Sweden and Europe at large, and in the European Union certainly now with Britain out of the European Union, that pattern is more homogeneous in Europe. So capital markets probably still a little bit underdeveloped compared to the US in particular. In terms of the negotiations, so these proposals, this particular legal file and all the proposals contained within was presented in December. One big part of that has to do with rules for prospectuses, but there's also separate proposals that has to do with how you prevent market abuse, those regulations, and also there's also other elements such as having multiple vote share structures. This is nothing new for Sweden. I'll mention that in a moment. But it's really a set of proposals. These negotiations typically take quite a long time in Europe. So some of you will be very well familiar with this process. I won't assume that everyone is. I'm simplifying a little bit, but basically the Commission will put forward a proposal. And then you have the Council on the one hand and the European Parliament on the other hand. Both need to have separate negotiations where they arrive at a position, which is basically a broad mandate for negotiations. And then you move on to the next stage, where you have what's known as trilogues or tri-party negotiations between the Council, the Parliament, the two co-legislators, and then the European Commission. And of course, it's the role of the presidency to try to broker all those negotiations. So my colleagues at the ministry, two of them are here today, are working extremely hard with this and traveling back and forth to Brussels. When I describe it like this, it sounds like it's a very short and simple process. It's not, for the simple reason that there's a lot of member states involved, and actually, in this case, there's also a lot of legislation involved. It's a number of different proposals, and it's really quite complex. So it's important not to underestimate the amount of work that goes into creating this sort of proposal and to then trying to also broker negotiations between these three parties, and in particular the two co-legislators. So right now during the spring, during the Swedish presidency, the Council and the European Parliament separately are negotiating their own positions, their own mandates for the further negotiations between them. My sense is that this is going quite well. We are trying to make as much progress as we can during the spring. I think the Council has certainly come quite far in that process, I can say. Hopefully, if the European Parliament also follows suit, then we should be able to move into these tri-party negotiations, which is a very important step to come closer to an agreement. We should be able to move into those, if not before the summer, then at least after the summer in the fall, which would be during the Spanish presidency. And then that should take some time too. But so far, I would say that we're making good progress and that things are really progressing according to schedule, so to speak. So that's roughly where we are in the negotiations. And then I'll say something about this, a couple of aspects that I think are interesting in a Swedish context. Some of these changes are bigger changes for Sweden and some are smaller. It's interesting to note that one of the proposals is to allow for multiple vote share structures. In Sweden, we tend to always think of it, I think, as dual class share structures with the A and B shares we've had for a very long time. This is controversial when you compare between jurisdictions. Here it's not about opening up for everyone, but it is about promoting this idea of allowing for that for smaller businesses. And the idea is, of course, really just to separate cash flow rights from control rights, and that as an entrepreneur you might want to retain a lot of the control over the company, but still want to draw in equity financing. So in that sense, the proposal could be seen as bringing the rest of Europe a little bit closer to the Swedish approach. That's noted. Another area which is more mixed in terms of the Swedish experience would be the role of the prospectus. And here we come back to this issue of possible trade-offs between, on the one hand, encouraging capital formation, making it easier to access this kind of financing. On the other hand, thinking about investor protection and what matters or doesn't matter for investor protection. So as far as I've learned, the role of the prospectus for issuers is very different across Europe. So one of the changes that's being proposed here is to really put a cap on the prospectus and say prospectuses can be much lighter than they have been. There's no need for them to be 500 pages. The thing is, they tend not to be 500 pages in Sweden. So this seems like a non-event here, but I just want to sort of make that point, that really the experience is very, very different across Europe. So that might not have a very large material impact on Swedish issuers, where prospectuses tend to already be shorter. There's also this even shorter version of the prospectus. I think it's the EU growth prospectus that's allowed. I think Sweden has something like half of all the EU growth prospectuses are from issuers in Sweden. Swedes really adopted to that possibility very early on. So in that sense, this seems like that's moving in the direction where Sweden has already been going. But there's also the element of what exceptions you make, who has to file a prospectus with FSA and who doesn't. And there's a few exemptions. One of them is really very broad, and that's a threshold value. So if the issuer is aiming to raise an amount below a certain level in a 12-month period, then they won't have to file a prospectus. And the current rules allow for differentiation here at the national level. Sweden has historically chosen to use that possibility and to really set the threshold very low relative to what's allowed. So it's 2.5 million euros as opposed to 8 million, which would be the sort of normal level today, and it's proposed to be raised to 12. So the proposal is really to raise the threshold, but also to harmonize it. That would require a slightly bigger change from a Swedish perspective. We can also note that Sweden has a lot of firms choosing to list relative to many other member states, considering its size. So it would seem that the requirement to file a prospectus, it doesn't seem to have prevented firms to a large extent from actually using markets when they wish to do so. Those are some considerations. That said, I guess it remains an open question to what extent the prospectus is important for investor protection, but I think it is good to be a little bit careful when proceeding in this area, not least because I'm sure plenty of people in this room work with corporate finance, think about corporate finance, maybe study corporate finance. My sense is that modern corporate finance, at least in theory, is very closely linked to the idea of asymmetric information. And we know then that you have to be very careful that if you weaken investor protection too much, you might run the risk of sort of undermining confidence in the market as a whole, which would then create, to use Alexander's vocabulary, some externalities for other firms too. So that's an area where it's good to keep an open mind. And of course, it's also good to realize that this is part of a larger project having to do with the Capital Markets Union. If every country takes every opportunity to differentiate, we're not going to have a Capital Markets Union, so you have to take and give, but it's good to also be a little bit cautious when proceeding in these areas. So that there's a trade-off there. I think that's really the key message. Okay, thank you.
Thank you very much. Thank you, Johan. Björn Jansson is senior partner at Carnegie Investment Bank since 2 weeks or 3 weeks or something.
A week and a half.
A week and a half ago. And prior to that, he was CEO of Carnegie Investment Bank for 8 years, or a bit over 8 years even. And before that, you were at SEB Enskilda, head of equity research. So you have a long experience of Swedish capital markets. So you have literally made quite a number of the deals we have been talking about in these markets, and we are very eager to listen to your views on this topic.
Okay, my name is Björn Jansson, and I've been in the Nordic investment banking business for 37 or 38 years. And I think I've done more IPOs than the rest of the audience together here. So I have some experience in this field, even though we don't take that much time thinking about, we just adopt to the rules there are. And of course, we sometimes feel that, okay, this could be done easier, that could be done in a different way. But of course, when I listen to people here and see this, that the shrinking stock markets and all that, it doesn't really, I don't recognize me, because that is not what we have seen here, as we saw on the first slide. We have had one, I think, Sweden, or the Nordics, and maybe Sweden in particular, have had the best functioning capital market in the world during the last 5, 6, 8 years. And then when you hear that the guys down in Brussels are going to change the rules how to do it, we get scared. Because what do they know about this? So why fix what ain't broken, we say. When we talk about this, everyone talks about listing requirements. We need to lower the threshold because that is what will create more IPOs. I don't believe in that. What creates more demand for IPOs? Well, demand side. The demand side is what one should focus on. Why is Sweden why do we have such an active IPO market in Sweden? Because we have a lot of investors who wants to invest in IPOs. And that is not the same if you go to other countries. So you should stimulate the demand side, not lowering the threshold for the supply side, because that, I think, only can increase the risk of, well, taking away the appetite for IPOs. Because if there is one thing that can kill the appetite for IPOs, that is if the listing requirements are so low, so people feel that, well, I invested in something that was not investable, then I will not come back. So therefore, I think, and maybe you should have expected me being an investment bank to say, lower the threshold, we can make more money. But I'm saying that it's important that we have credibility in the stock market, credibility in the IPOs. And therefore, I would say, of course, as everyone has said, it's a balance here between investor protection, transparency on the one hand, and cost on the other side. And of course, we need to find the right balance. But what I think is important is that we have harmonization, so that stock markets don't compete with each other with lowering the requirements, because that, I think, could be dangerous for the stock market. So harmonization is extremely important. And then stimulate savings. And I think what are the unique things with Sweden? There are no other country have so many mutual funds focused on small and mid caps in relationship to its size. Where does that come from? Well, that comes from tax incentivized savings that was created some 40, 50 years ago. Allemansfonder in Sweden, or they were also something before Allemansfonder. Then you have a lot of retail participation in IPOs. And I think the Swedish ISK, where you can save in shares in a very efficient way, tax efficient way, has created a large demand. So you have a lot of investor participation. I think we should focus on those sides. How do we create larger demand for IPOs of smaller companies, so that it's not just the big index funds who buy big names? And I would say that out of I guess we have done something like 200 IPOs in the Nordic, or in Sweden the last 3 years. And I would guess that 199 of them classified as small and mid caps. So there is a big demand for this. Then a note, we talk here about private equity, and that maybe private equity has taken a part of the companies. I think it's quite interesting. We sometimes talk about private equity as being kind of well, some kind of form here. But we have to remember that private equity, that's pension money. It's exactly the same money that buys the shares on the stock market. So what I think is kind of interesting is that there seems to be different rules for pension funds to own companies through a private equity firm instead of owning them directly. Here I think we need to also see some harmonization. How do we look upon things? How do we look upon risk? What is risk? What is underlying economic risk? We all know that have studied at this school that risk, the theory of risk goes back to Markowitz, and we always measure it as volatility or standard deviation afterwards. Afterwards, is there any risk at all in retrospective? While private equity, if you're unlisted, you make a valuation 4 times a year. Not much volatility in those shares. So have we created a way of measuring risk so that liquidity increases the risk and that the asset managers need to have unlisted equities because that creates perception of that the risk is lower because volatility is low? I think that is something that someone at a school like this should think about. How to measure, how to improve the measurement of risk and between different asset classes. So I would say listing requirements, I don't think that is, to lower them, I think that's dangerous. I think it should be harmonized across the world if I were to choose, so that there is the same thing everywhere. And I think if we should stimulate the European IPO market and make sure that more companies can get access to it, stimulate saving and keep good standards so that we, on the listing requirements, so that we get good companies that are listed, because that gives credibility to the stock market. Thank you.
Thank you. Okay, can we have all the panelists up on stage and on the screen? There are lots of questions to be discussed this, and I said the audience has priority, but I thought maybe we could start by giving the panelists an opportunity to comment on each other to the extent that you have. Alexander, this last thing Sven said about measuring risks, and that was a challenge for you.
I don't know whether it's a challenge for me, but it's a very interesting point to make, to think that measured volatility increases in the liquidity of the asset that's being traded. And if you have a lot of illiquid assets in your portfolio, you can pretend that you don't have much volatility. And I think to some extent, that is the world that we're in, that there is a shift towards types of investment opportunities for regulatory reasons or for this kind of perceptive reasons. But I wanted to come back to something else that Björn said. And I actually agree a lot with what he said. I also don't think that reducing listing requirements is the way to go. I don't think we want to have a race to the bottom. But we need to be careful when we talk about listing requirements because there's so many listing requirements. So Nasdaq has umpteen rules. Eun Ah can tell us exactly how many they are. And some of them, I think, are critical for addressing the kinds of issues that Johan was talking about to do with investor protection and information asymmetries. So disclosure rules, listing rules, I think are very important, and we should be very careful about what we do with those. But there's so many other listing requirements that are virtue signaling, that come about because of political processes, that are about things that are really nothing to do with investor protection. And stock market listed firms are required to abide by those listing rules as well. And they're costly. And whether we want to do something about those types of listing rules, I think, is a separate discussion.
Okay. Johan, you have any
No, I mean, I
comments
think
on what you hear?
this is a really great kind of discussion from the commercial side as well as regulatory side and academic. And I think we all have the same goals in mind in terms of creating this kind of vibrant market with efficiency and liquidity that's appropriate for retail investors. I think that's the ultimate goal. And I think people, where we have differences ultimately, not we, this panel, but just overall market participants, is sort of how to get there. And it's not always an easy process. And I think there's also politics involved, just coming from the US side where things have become very politicized. It is hard to kind of take a step back sometimes from some of that and really think about sort of what is driving the market and how the market should be driven based on data and try to balance the three-pronged goals that I had mentioned before.
Johan, any?
I just wanted to second Björn's point, which I think was very important to think about the demand side. It's probably not a coincidence. It's a small sample, but it's probably not a coincidence that Sweden has a very active listing environment, really uses these markets relatively well compared to large parts of Europe, and also has a long tradition of direct ownership of both equities and mutual funds among just ordinary savers. And that is strikingly different when you compare with some other also very large jurisdictions in Europe. I think there's a very old, long-standing debate in economics about sort of which moves first, supply or demand. I'm not going to say that supply will create its own demand in these countries. I think that would be hoping for too much, but it's more just to agree with that point, that you have to look at both those sides. Sweden has had, for example, these various forms, these savings products for a long time. I think the most recent big change there was about 10 years ago with the introduction of this investeringssparkonto, which is basically an account where you have listed equity mutual funds, and then I'm sure you know how it works, but it's taxed on an imputed return basis, so you have to have some sort of clear nominal value of the assets there, which means that you can't have unlisted equity, you can't have those forms there. So that's clearly a big advantage for those choosing to use a listing. On the other hand, you have the other development with PE, where if you let people value things as a few times a year, then of course you're going to create a big advantage as long as you're trying to measure standard deviations or something. So that's I think that's a very important point, to think about the whole ecosystem and not try to solve everything with just the listing rules.
Does Björn have any comments?
But also, I think one could add if you're going to sell an asset, whether it's your car or the company, you sell it to the one that pays the most. So when there are few IPOs, there's probably someone else who's willing to pay more than the stock market. So, and then that's irrational behavior. So therefore, it is a question of making sure that valuations are right. And I would say that when you have booming IPO market, the IPO market is paying better than the private market. So I think it's also a question about pricing on the different types of markets. And that goes back to then this, that we look upon things differently, and we put different pressures on a listed company compared with a private company, even if it is the same owner in the end that have owned the two types of companies. Because if you're looking at private equity, I would say it's primarily pension money. And if you look at the stock exchanges, it's primarily pension money. So it is the pension money that seems to have different views on what pressures to put on the companies, whether they are listed or non-listed.
Is that for regulatory reasons or?
I don't really know. But I guess that there are some regulatory reasons.
It's a closely related issue. I'll tread very gently here for several reasons. One is that Sweden has the presidency, and the views of my member states are very different on this. And the presidency is expected to take a bit more of a neutral stance, at least in public, and be an honest broker. The other reason is that a lot of the legislation in this area is with the Ministry of Finance and with the Financial Markets Department, but not insolvency laws. That is with the Ministry of Justice. So really, we would need my colleagues from the Ministry of Justice to give you a more detailed answer on that. But I will say it is a closely related issue. It's part of this capital markets union package, the greater package from the Commission. It's a separate legal file, but it's also there. And it's clearly an area where we're nowhere near harmonization in Europe. These laws are very, very different. So again, clearly, if every country sticks to its guns and wants to differentiate as much as possible, we're never going to have a capital markets union. At the same time, if we think that we're doing something right, with the A and B shares, there's some recognition, I think, in this proposal that there's something appealing about that. That's nice for a Swede. Other elements, maybe not the legal files, it's easier to see that there could be some disadvantages relative to what we're used to. I'd say another area which is within the legal file would be something like insider lists, where in Sweden we've really taken it, I won't say to one extreme, but there's a strong preference for event-based lists, and here in the proposal it's much more of the direction is much more towards permanent lists. And again, that's very different from how we've been working. So you have to strike a balance between harmonization and not trying to change your rules too much relative to where you want them to be.
Does Björn or Eun Ah or Alexander want to comment on?
I mean, I think, Andreas, your question kind of goes to what Björn had said in terms of demand, right? I mean, there are fiscal policies and regulatory changes separate and apart from the disclosure rules and the listing standards that have a huge impact on how the demand is created for capital formation. And, in the US, there's a lot of discussion about tax reform as one of those things, as well as litigation reform. The US is a very litigious society, and that puts a lot of pressure on companies and increases expenses. And so it's all part of, I think, one broader discussion. And I think when we're thinking about capital markets and capital formation in particular, we can't just look at it from a sort of a very narrow lens, but really have to think about it in a broader fiscal policy as well.
But you have the advantage in the US to at least have harmonization from a very, very early stage.
Yes, that is true.
That we're still trying to achieve on the European level.
Yeah. Although, different states have different laws as well, privacy, competition for employees. So but totally understand from a capital markets and securities law standpoint, we do have the federal regime that applies to everybody.
The share of economic activity that is done by privately held firms in the US is enormous. I looked at that a few years ago, and unfortunately, I'm sort of walking on one leg at the moment, so I can't hop to my laptop and dig it up for you. But very roughly speaking, if you look at profits, if you look at investment, if you look at employment, if you look at innovation, the share of economic activity by privately held firms in the US is more than 50%, which I found very surprising. And if I just take one of those dimensions out of it, namely innovation, then the share of patents that are awarded to privately held firms rather than publicly traded firms is increasing. And the share of high impact patents in the US that is awarded to privately held firms is also increasing. So those kinds of trends would suggest that there's a lot of economic activity that we should care about that's happening outside the spotlight of the public markets.
It's not really a precautionary motive, but just there's some merit to having more than one source of financing, right? So in Sweden, we've had relatively good credit growth also with the bank-based system. But if you picture a scenario where maybe there's more of a contraction there, lending gets a little bit more strict from the banks to have good access to not just equity financing, but also debt financing through markets. It just opens up more possibilities. And I think the US is ahead of Europe on that, also compared to Sweden.
And I guess, yes, there is a lot of talk about buybacks and things like that on the stock market, but that is for the large mature companies that have kind of passed the level where they need financing to grow. And I think when we look upon the number of companies that are doing IPOs or even a lot of them comes from private equity, but there are also a lot of entrepreneurs who are actually seeking real, call it money, to grow their business and to live their dream. And I think that's very important. And of course, SKF, they don't need to get access to new capital to grow. But I guess we have a lot of entrepreneurs that are desperately need for having a stock market there to get access to risk capital.
And if you're looking at the pipeline and if you're sort of looking at the cycle of these things, generally speaking, I do think that there will be a time when one or two IPOs are able to go through with much success and it will create momentum. Whether that is within 2023 or beginning of 2024, we don't know. But I am optimistic, though, that there are companies that are ready to go public. at the right time, and they may be using other financings, whether it's private, bank loans, or some other methods of capital. I do think that there will be a time when we do see these sort of opening up the gates for companies wanting to become public again.
I think the savings products we talked about, that's largely about the tax rules, and they tend to be quite different in different jurisdictions. But maybe more countries could learn from the Swedish example.
I think the research landscape on this is in flux. I have published in this area myself, and the results that I come up with suggest that privately held firms are actually better at investing. They take more of a long-term view, and they're more efficient at investing. They also invest more, just in dollar terms, than comparable publicly listed firms. So you want to hold some stuff constant before you look at that. So firms of same size, same industry, and so on. But there are also other studies out there that come up with the opposite conclusion and say there is no short-termism, and this is not something that we need to worry about, and the debate is overblown. So we don't have a consensus on this, but to the extent that you believe that getting incentives right matters for investment and capital efficiency, and you believe that private equity firms are actually quite good at putting good incentive systems in place, there would be an advantage to being private rather than public from that perspective.
Anybody else on that topic? You know?
I mean, I think even the CEOs and CFOs of public companies will tell you that it is hard to manage from quarter to quarter, and you know, they would prefer to have sort of a longer-term view when it comes to engaging with their investors. So there's something to be said about that, and I think there's also a lot to be debated about in terms of, you know, deal class structure is sort of one of the areas that people talk about. And I think there are also sort of shareholder activism, and within the US there's also push to provide more disclosure or require more disclosure from shareholder activists as well. So there's a lot of different sort of levers that I think we have that is being sort of tested as we sort of think about how to get that right. And I'm not sure if anybody has the right sort of level of sort of balancing at this point in time. And I think it'll be something that we continue to debate for a very long time, unless there are some drastic changes in terms of whether it's disclosure requirements or some kind of other corporate governance structure.
Okay, Johan, I read somewhere that the Swedish government has prioritized or sort of said this is an important area for during the Swedish presidency to promote creating more efficient capital markets and the capital markets union and so on. And sort of Sweden, somebody said that, this, I think Björn said that this is one of the better functioning capital markets in Europe, and I certainly agree with that. Maybe the best per capita, because it's a small country. So why is it in Sweden's interests to promote improvements in this area?
I think once you think of it as part of a larger, broader priority, which is really improving competitiveness in Sweden and in Europe as a whole, the single market is a very important part of that, and the capital markets union should be seen through that lens, really. It's one of the areas where Europe perhaps hasn't made that much progress yet in terms of bringing the benefits of scale and also just increased competition. And I think we have probably in Sweden plenty of also financial firms that are strong, that are leaders, and that shouldn't be afraid of increased competition and getting improved access to other markets in Europe as well. So probably something to be gained for them as well. But I think really the priority here is about improving competitiveness for the real economy, and then the ability of firms to access financing of different kinds, the kind of financing that suits their particular needs. That's the real purpose of that.
Does Björn have a comment?
No, I kind of agree that of course I could say that it's better that we only in Sweden have this very good situation, because that is beneficial for me as representing Carnegie. But I would say we have to take a broader picture here and say that it's important for corporate Europe that we have well-functioning financial markets, and therefore I think it's very good that the government take this as a priority area.
Can I just,
Absolutely.
I can just actually
That's why
speak
you're
on
here.
that. We had a question earlier about the insolvency law. I mean, it's important to think about it in those terms as well. I mean, obstacles to cross-border activity can simply be that you have very complicated legislation that differs a lot between member states, and that is very closely linked to the investor protection motive. It might just simply increase interest in activities from Björn and others in Sweden, from other parts of Europe, if you make these rules a little bit more harmonized. Then you have to think very carefully about which rules you want to harmonize more and which ones less, and what the cost is, and so to speak. But I think it's important to take that seriously, this idea that just simply the fact that there are differences in legislation, where legislation is very complicated, creates an obstacle in itself.
And harmonization is investor protection. Because how is it possible for a retail investor to understand that there are different listing rules? If there were different listing rules in every country in Europe, then you become, harmonization is investor protection.
Thank you so much for coming. It's been a great debate, and above all, thank you, panelists Alexander on the screen, Björn, Eun Ah, and Johan, with an applause. Thank you very much.